Target limited, a nice easy question. By now you should about spend not longer than 15 minutes to get this question done. Target Limited is a company located in Johannesburg and who sells running shoes to sports shops around the country. The company obtains inventory from a supplier in the USA and makes a profit margin of 50% on the cost price for normal sales to the public. So these are normal sales. You can write it down for yourself. 100 plus 50 equals 150. Good. Normal sales. I don't have to do any calculations. They give it to me. On 30 April, the company discovered that damp has seeped through the walls of the storeroom. Almost the entire inventory, with the exception of the inventory with the selling price of 330.75. That was sold in a separate area, was damaged and could not be sold. Furthermore, inventory with a cost price of 8,400 Rand was damaged but can still be sold for 3,150 Rand. Fortunately, the company had insured their inventory for 63,000 Rand. The following information for the period from 1 May to 30 April 2013 is available. Now, 30 April 2013, it was when they discovered the damp. Delivery costs, import duties, storing costs, sales and payments to creditors. Sales from a clearance sale during the financial year up to 30 April 2013 in that period amounted to 1050 at cost less 25%. So they also give you this formula here. So as soon as it costs less something, cost becomes 100, less 25% of 100 equals 25. So my selling price was 75. Write it down for yourself. I'm going to use that. And I gave you the sales proceeds, which was 1050. The following balances inter alia are available. Inventory in the storeroom on 1 May 2012, so my opening inventory. And then I have my opening balance of creditors and my closing balance of creditors. Now, if you look here, nowhere do I have purchases. I only have creditors. And creditors and purchases ain't the same thing. But how do we account for credit purchases? We debit purchases and we credit creditors. So probably by reconstructing my creditors account, because I also have payments to creditors there in my list of balances, I maybe can work out what purchases was. And that is really the catch of this whole question. If you had that, then you had the whole question in hand. All purchases are made on credit. So there's no other purchases except the purchases that's recorded in the creditors account. The company is not registered for VAT purposes. All amounts include VAT, but that is by the wayside. The financial year end of the company is 30 April. Calculate the value of the claim that will be instituted against the insurance company resulting from the loss of inventory. The averaging clause does apply. So we know that in order to calculate the value of the claim, I need the insured amount. I have the insured amount. I have to have the theoretical inventory on hand as at the date that I have discovered this damp, which is 30 April, and that probably is the one I'm going to work out. I have to work out the value of the loss. Now for that I need the closing inventory, the have me the cost of the goods that were salvaged, and then probably I can work out the claim. So let's start at the beginning and let's start working out our estimated theoretical value of stock just as at 30 April 2013. Where are we going to start? We're going to start with our, what is cost of sales? Cost of sales is our opening inventory, 67,200, plus purchases, park that one for the moment, plus purchase related costs, 12,300 Rand, non-claimable duties, 11,400 Rand, storing costs, we are not allowed to capitalize as the part of the cost price of an item, so you're going to ignore the storage cost. Sales we're not going to work with now, and payments to creditors. So the missing link here in the cost of sales calculation is really purchases. So let's start by reconstructing our creditors account. Our opening balance for creditors was 87,633. So opening balance 87,633. Then I said that we've made certain payments to creditors 76,580. So we credited bank and we debited our creditors account with 76,580. Then furthermore, they say that our closing balance for creditors was 111,853. Now, creditors got a credit balance, so when we bring over the balance, so above the line, it will be on the debit side. So closing balance, 111,853, and then we will bring that balance down on the credit side where it should be. And that's the balance that determines whether it's an asset or liability. So that 111,853 brought over on the debit side, that then will give us a total on the debit side of 188,433, 188,433, and my balancing figure will then be my purchases figure for the year, which is equal to 100,800 Rand. Now we can calculate cost of sales. Cost of sales, we said, is opening inventory plus purchases, the amount that we've just calculated, 100,800, plus delivery costs, plus import duties, no storage costs because you're not allowed to capitalize it, give you the cost available for goods to be sold, 191,700, and let's see if we can't work out cost of sales. Now, the question tells us that we had special sales for the year, and that amounted to 1050, and there we have actually put down our profit formula, 100 less 25 equals 75. So the cost of sales will be 100 divided by 75 multiplied by 1050. 100 divided by 75 multiplied by 1050, which gives us 1,400 Rand. Then our normal sales for the year, we also know what that is, because our normal sales for the year in our question was sales 130,200. They say here these sales are not included in the above amount. So therefore I must use the full 130,200 because that is my normal sales for the year. What is my normal profit percentage? There I have it. So to work back the cost price, it will be 100 divided by 150 multiplied by 130,200. That gives us 86,800. If I add the 86,800 with the 1,400, it gives us total cost of sales of 88,200. Now the only missing amount is now, is that amount there. This closing inventory. So 119,700 we've already calculated. We know that the answer must be 88,200. So what is the balancing amount? Closing inventory must then be 103,500. The question wants us to calculate the value of the claim. So therefore we must first calculate the value of the loss that was incurred. Our theoretical closing inventory was 103,500. They tell us here that with the exception of inventory with a selling price of 33,075, everything was destroyed. So 33,075 multiplied by 100 divided by 150 will give us the cost price. That is what we're looking for, the cost price of that inventory that was salvaged. So 33,075 times 100 divided by 150 gives us 22,050. So the actual loss that the entity has encountered was the difference there of 81,450. For the claim, the first thing that we need is the insured amount, 63,000 Rand. The second thing that we need is the value of our closing inventory as we've calculated, 103,500, multiplied by the value of the loss, 81,450. So in total, the claim equals 49,578. Then the insurance says, wait a minute, can't you recover something for those damaged goods? Is there a possibility that you can sell some of those damaged goods? And they said, yeah, some of the damaged goods can still be sold for 3,150 Rand. So the insurer says, well, I'm not going to pay you that amount. You have to subtract that from your claim. So the net amount that you can claim from me is 46,428. This company is not registered for VAT. Therefore, they cannot claim VAT from the insurer. So this will be the total claim. The last portion of the question asks you to process the journal entries. Now, our closing inventory should be reflected in our books at what value? Number one, the value of the undamaged stock. There's nothing wrong with that, so that is still the cost price. Here's our damaged inventory, that 81,450. And that 81,450 has got a net realizable value of 3,150 because I can sell some of that damaged inventory for 3,150. Therefore, my inventory should be reflected in my books at the end of the day at 25,200 Rand. Our actual inventory in the books is now 103,500 Rand. It should be reflected at 25,200 Rand, so therefore I need a write-off in my inventory account of the difference, which equals 78,300. So I'm going to debit an inventory loss account, which is an expense account, 78,300, and I'm going to credit inventory, 78,300. Then I have to record the claim in my books. Now the claim in my books is going to be 46,428. There is absolutely no VAT applicable, so that will then reduce that loss of the damaged goods that was going to come out of our own pocket, because we can recover some of that loss from the insurer. So you're going to credit your inventory loss account so that it only reflects the amount which you are going to pay. The question also asks you, what was the statement of financial position going to look like as at the end of June? So you're going to have inventory at what value? And we've already calculated the value. We said our closing inventory must be the net realizable value of the damaged stock of 3,150 plus the value of the undamaged goods, 22,050. So inventory will be shown at 25,200 in our statement of financial position as of 30 June 2013.